Welcome back. Today we're diving deep into the UK's high-end property market. It seems like confidence there is, well, facing a massive freeze right now.
It really is.
Our mission is to understand what happens when, political policy rumors start running wild.
Hmm.
Because prime market sentiment, it's currently sitting at a shocking 5-year low.
Yeah, and what's really critical for you to grasp here is that it's not an actual policy change that's causing this freeze. Not yet, anyway.
Right.
It's the speculation. It's quite unprecedented, actually. Specifically, all these rumors swirling about extending capital gains tax, CGT, on the sale of high-value homes. That talk alone has just eroded buyer and seller confidence.
Okay, let's try and quantify that damage then. There's a recent Savills survey, right? It reveals 37% of prospective buyers and sellers, they're just less committed to moving in the next 6 months.
37%.
Yeah, that's the lowest confidence level we've seen in half a decade. And it seems to be hitting second home buyers and investors the hardest. They're the ones putting plans on hold.
And you see that lack of commitment immediately translating into, well, falling valuations. Particularly in prime central London PCL, as we call it.
Okay.
Over the third quarter, Q3 PCL values dropped by 1.8%. Now, to give you some perspective on that,
Yeah.
that's the largest quarterly fall since December 2016. Remember back then?
Yeah.
Just after those big stamp duty changes and the Brexit vote uncertainty.
Ah, right. So similar scale of impact almost.
Pretty much. And overall, it means PCL values are now sitting, get this, 24% below their peak back in 2014.
24%. Wow, that's a massive correction over time. But okay, let's dig into the market segments a bit. Is all luxury property seeing this kind of pressure? Because some data suggests the very top end, the ultra discretionary 10 million plus category, that's where it's really vulnerable.
Absolutely. That's spot on. The vulnerability at the very, very top is definitely compounded by previous regulatory shifts too. Well, think about the changes to the non-dom regime. Those rules affecting UK residents whose permanent home, their domicile, is overseas. That pool of potential high net worth buyers had already shrunk significantly because of those changes.
Right, right. So the pool was smaller already.
Exactly. And now the remaining buyers, they're just, understandably, waiting for some certainty before they make a move. It's just too much ambiguity.
Wait a second. So Lucian Cook at Savills points out that the speculation itself is what's curtailing the market activity now. It's forcing reliance on what he calls needs-based buyers.
Yeah, people who have to move rather than want to move for investment or lifestyle reasons.
Okay, but doesn't that mean the Treasury is actually losing out on potential transaction tax revenue right now simply because they might raise taxes later? That seems kind of like a self-inflicted wound, doesn't it?
It's a significant paradox, definitely. The uncertainty freezes out all that highly discretionary money, the big deals, leaving the market more reliant on, say, domestic families needing more space, people moving for schools, jobs, that kind of thing.
Ah, okay. And that actually explains those pockets of resilience we're seeing, maybe, like how house values are holding up better than flats, particularly in those family-oriented London markets.
Yeah.
Places like Barnes, Wimbledon.
Precisely. That's where that needs-based domestic demand is providing a bit of a floor under values, specifically for houses.
Okay. And if we zoom out a bit, look regionally. We're seeing urban markets generally doing better than their more rural counterparts. Does that suggest the whole post-COVID dash for space thing is correcting itself now?
Yeah, I think that's fair to say. We are seeing continued relative strength in city centers. Think Edinburgh, Cheltenham, York, for example. They're holding up better. So while overall prime regional values are slightly down, about 1.3% in Q3, the bigger picture, the lesson here, is that the post-pandemic correction is definitely still playing out.
So places that surged fastest are now falling back.
Exactly. Those prime country houses, for instance, saw huge growth after COVID now. They're seeing sharp annual falls, down about 8.1% year on year. But you have to remember, that's coming off the back of really rapid surges. The Cotswolds, for example, grew something like 18.4% over 5 years. So it's a pullback from a very high level.
Right. Context is key there. Okay, so wrapping this up. What does this all mean for you, our listener, if you're maybe a high-end property owner or potentially looking to buy? It seems pretty clear. Policy uncertainty is acting like a paralyzing agent right now.
It really is. It's locking up capital. It's stopping investors, even just regular wealthy buyers, from being able to properly calculate their risk in a market that's just defined by rumor at the moment.
So everything's just on pause.
Pretty much.
Yeah.
But here's the final thought. While the market is definitely slow, maybe even frozen in parts right now, there remains this massive underlying pent-up demand from people who are eager to capitalize on what some see as, quote, historic value currently available.
Ah, interesting. So potential opportunity amidst the gloom.
Potentially, yes.
Yeah.
So the real question for you is, how long can this political uncertainty actually hold back these cash-rich, high-value buyers before they decide, you know what, the time is right to jump back in? Regardless, how long will they wait?